Why most people never become successful investors. Imagine you invest your first $1,000 into the stock market. You've finally done it. You're an investor. A week later, you check your account. Your investment is worth $930. Your phone is flooded with headlines, market crashing, fears of recession grow. Friends start telling you to sell before it gets even worse. So what do? For most people, this is the exact moment investing stops being exciting and starts becoming emotional. And that emotion is usually fear. The truth is, investing isn't difficult because the math is complicated. It's difficult because nobody teaches you how the market actually works. We're left to figure it out while our own money is on the line. Most people think successful investing is some kind of treasure hunt. It's about finding the next Apple or the next Nvidia before anyone else does. But that's a myth. The world's greatest investors don't spend their days chasing the hottest stock tip. They do something far less glamorous. They focus on understanding businesses, on controlling their own emotions, and, most importantly, on giving their investments time to grow. So let's start with the single biggest misconception, the one that trips up almost every beginner. People say they buy stocks, but what are you actually buying? Let's use an example. Imagine Apple, a company worth roughly $3 trillion. It's almost an impossibly large number. Now, imagine slicing that entire company, its factories, its brand, its iPhones, its cash, into billions and billions of tiny, equal pieces. Each one of those pieces is called a share. When you buy one share of Apple, you're not just buying a ticker symbol on a screen. You are buying a tiny, fractional ownership stake in the entire company. You're no longer just a customer who buys their products. You are, in a very real sense, an owner. And as an owner, your interests are aligned with the business. If Apple sells more iPhones, if it grows its profits, if it becomes more valuable over time, then your small piece of ownership becomes more valuable too. That is a completely different way of thinking than simply watching numbers move up and down. It's the difference between gambling and investing. You're not betting on numbers, you're investing in businesses. This is exactly why the legendary investor Warren Buffett famously says that when he buys a stock, he imagines he is buying the entire business. He's not thinking about what the price will be next week or next month. He's thinking about whether the business will be stronger and more profitable in 5, 10, or 20 years. Because that's what you're doing on a much smaller scale. You're a part owner. Okay, so if stocks represent ownership in real, tangible businesses, why do their prices seem to change every single second? A business like Apple doesn't become 1% more or less valuable between breakfast and lunch. That's where most people start getting confused. It's the disconnect that causes all the fear and bad decisions. And once you understand it, the stock market suddenly starts to make a lot more sense. Why stock prices move and why volatility isn't the enemy. When you see a stock price drop, it's easy to assume the company just had a bad day, a failed product launch, a disappointing sales report. We think of it like a report card on yesterday's performance, but that's not what's happening. The stock market isn't looking in the rearview mirror. It's a massive, chaotic, collective attempt to predict the future. Every single price, every tick up or down isn't about what happened. It's about what millions of people believe will happen next. Imagine a company announces record-breaking profits, the best quarter in its history. The stock should soar, right? But it falls. Why? Because the millions of investors pricing that stock weren't just expecting good results, they were expecting a miracle. Their expectation was even higher than the record-breaking reality. And in the market, expectation is everything. Now take that one company's story and multiply it by thousands, and then start stirring in all the other ingredients. What are interest rates going to do? What about inflation? Is the economy growing or shrinking? What's happening with global politics, or the latest breakthrough in AI, or how much people are spending at the mall? Suddenly, you see that every stock price isn't a simple number. It's the temporary result of a global argument between millions of competing opinions. This constant, unending argument creates what we call volatility. It's a word that scares a lot of people. Volatility just measures how much prices are moving. Some days it's a calm lake. Other days it's a storm with prices swinging wildly. New investors see those swings and think it's pure danger, but volatility and danger are not the same thing. Picture two investors starting out today. The first one watches the market like a hawk. The moment her stocks start to fall, she sells, trying to avoid the pain. The second investor understands that these drops, these storms, are a normal part of the journey.
She holds on, maybe even buys more. Now, fast forward 20 years. Who do you think is better off? History gives us a clear and unwavering answer. During the 2008 financial crisis, the market lost more than half its value. Headlines screamed that the system was broken. During the first weeks of the pandemic, stocks crashed over 30%. It felt like the world was ending. And yet, every single major decline in history has been followed by an eventual recovery. That discomfort you feel during a downturn, that stomach-churning anxiety, that's volatility. It's the price of admission for earning long-term returns. It's what shakes out the people who can't handle the pressure. The real danger isn't that the market moves up and down. The real danger is making a permanent, emotional decision based on a temporary feeling of fear. It's believing the storm will last forever and jumping overboard right before the sun comes out. And that's the mistake that costs investors everything.
The psychology that makes investors lose money. Imagine two people. They start with the exact same amount of money. One invests it and over the years becomes wealthy. The other, well, they barely make any progress at all. The difference between them usually isn't intelligence or some secret financial knowledge. It's psychology. It all starts when the market is booming. News headlines are a constant celebration of record highs. Everyone around you, from coworkers to neighbors, seems to be an investing genius talking about their big wins. A powerful feeling takes hold, the fear of missing out. It feels like the safest, most logical thing in the world to join the party. So you buy. You jump in when the excitement is at its peak. But ironically, this is often when prices are already stretched, when assets are most expensive. And then the market falls. The mood shifts instantly. Fear spreads like a virus. News channels, which just weeks ago were cheering the rise, now predict recessions and economic doom. Social media fills with stories of people losing their savings. Instead of seeing lower prices as a bargain, as an opportunity, your brain screams, "Danger!" The instinct for self-preservation kicks in. You sell just to make the pain stop, terrified of losing even more. And without realizing it, you've done the exact opposite of what every successful investor knows to do. You bought high, driven by greed and social pressure, and you sold low, driven by fear and panic. This predictable, self-destructive cycle happens because of a deep-seated quirk in our mental wiring that psychologists call loss aversion. The research is clear. Losing money feels far more painful than making the same amount feels rewarding. Some studies suggest the sting of a loss is twice as powerful as the joy of a gain. Our brains evolved over millennia to avoid immediate threats, to run from the predator in the grass. They are hardwired for survival, not for the abstract, long-term game of the stock market. This flawed wiring also leads to another common mistake, trying to time the market. People convince themselves they can outsmart everyone. They'll wait for the perfect moment to invest, for the absolute bottom of a crash. The problem is, nobody can consistently predict the market's highest or lowest point. So many would-be investors spend years sitting on the sidelines, clutching their cash, waiting for a crash that may or may not come. And while they wait, they miss months, even years of powerful growth. They miss the very thing that builds wealth. That's why the most experienced investors focus less on predicting the market and more on something far less exciting but infinitely more effective: consistency. They invest steadily over long periods of time, through the good times and the bad. They understand that consistency almost always beats a futile attempt at perfect timing. Which brings us to the most powerful concept in all of investing. It's not a complex algorithm or a secret strategy. It's the one asset we all have, but our own psychology often convinces us to squander. That concept is time. Why time beats almost everything else? If I gave you two choices, would you rather earn incredibly high returns for just a few years or slightly lower, steady returns for decades? Most people jump at the higher return. We're wired to want more, faster. But history and a little bit of math suggests that's often the wrong answer. The real magic of building wealth isn't just about the rate of return you earn in a single year. It's about allowing those returns to compound year after year after year. Imagine planting a tiny sapling.
For the first few years, you barely notice a difference. It seems like nothing is happening, but underground, the roots are spreading deep. Then, slowly, it starts to grow. And as time passes, each year of growth builds on the last. That small sapling eventually becomes a towering tree. Your investments work the exact same way. In the beginning, your money earns returns. It's a nice feeling, but it's just the start. The real power kicks in when those returns start earning returns of their own. That's compounding. It's a quiet, patient force, but it's unstoppable. This is why someone who starts investing in their 20s can often end up with significantly more wealth than someone who waits until their 40s, even if that second person invests far more money each month. The person who starts in their 20s simply gives their money more time to work. They give that sapling more seasons to grow. Time is the ultimate multiplier. But what do you invest in? This is where another crucial element comes into play: diversification. Let's be honest, no one knows which company is going to dominate the next decade. 20 years ago, very few people would have predicted that a company primarily known for making graphics cards for video games would become one of the most valuable businesses in the world. But that's exactly what happened with NVIDIA. You don't have to be a fortune teller. Diversification is your defense against an unknowable future. It allows you to benefit from the future winners without having to predict exactly who they'll be. By owning a small piece of many different companies, you ensure you have a seat at the table when the next NVIDIA emerges. At the end of the day, investing isn't a lottery ticket. It's not about getting rich overnight. It's about the slow, steady process of buying ownership in productive businesses, learning to ignore the short-term noise and the scary headlines, and staying invested, especially through the rough patches. It's about letting time do the heavy lifting for you. The stock market has created enormous wealth over the last century, and it wasn't because every investor was a brilliant genius who could predict the future. It was because patient investors simply stayed out of the way and allowed the power of compounding to work in their favor. So the question isn't whether the market will experience another crash. It will, that's a guarantee. The real question is whether you'll see that moment as a reason to panic and sell, or as an opportunity to stick with your plan and continue building long-term wealth. If you enjoyed this breakdown, subscribe to the Wealth Blueprint, because next we'll dive even deeper into how Warren Buffett, index funds, and investor psychology have shaped some of the greatest fortunes in history.